Welcome to The Explainer. If you've been glued to the charts lately, you know it has been an absolutely wild ride for precious metals. There's a lot of noise out there right now, so today we're going to cut right through it and dive deep into the recent market action using the very latest data and analysis from Summit Metals. I mean, we just lived through the worst gold quarter since 2013. Naturally, that sparked a ton of anxiety, and it's left a lot of investors stressing over one specific question: did I buy the top? It's a totally human reaction to see sudden drops and panic, but to get the real answer, we have to push past the emotion and focus strictly on the data. All right, so here is our roadmap for today. 1. The recent market pullback. 2. Unpacking those bank price targets. 3. Macro drivers and the Fed. 4. Summit Metals forecasts. And 5. Your action plan. Let's just jump right in. Starting with Section 1, the recent market pullback, margin calls, and market snaps. Now, what looked like this massive structural break, it was really just a violent reaction to market mechanics. Yes, we saw the worst gold quarter since 2013, but it was driven heavily by silver margin calls. Basically, traders were forced to sell their assets just to cover their borrowed positions. We saw silver drop below $60 and then snap back incredibly fast. Meanwhile, ETF short selling pressure literally plummeted 40 points in a single week. The Bank for International Settlements even confirmed that this crash was amplified by leveraged retail traders getting liquidated. So the takeaway here, this isn't the start of a bear market. It's just the market building a base after a massive forced sell-off. Moving on to Section 2. Unpacking bank price targets, specifically the 6 downgrades. You probably saw the headlines that caused all the panic. We had 6 major desks issuing sudden downgrades. OCBC in Singapore cut their target to 4,360. Goldman is sitting at 4,900. Bank of America and Deutsche Bank are at 4,800, while Morgan Stanley and UBS are holding at 5,200. It sounds totally terrifying when they all cut at once, right? But things get really interesting when you actually compare these so-called downgrades to today's spot price of 4,152. The media totally ran wild with that scary headline about slash targets. But here's the underlying reality. The absolute lowest downgraded target on that entire list, OCBC at 4,360, is still 5% above today's spot price. None of these banks are predicting a crash. They are literally just lowering the ceiling a tiny bit. And this brings us to the absolutely crucial takeaway: 17%. If you average all 6 of those downgraded targets together, you get 4,877. That is a massive 17% premium above current prices. Think about it. Normally, if someone offered you an asset with a consensus 17% upside by year-end, you'd be thrilled. But because the media framed it as a downgrade, the market panicked. All right, Section 3, macro drivers and the Fed. What is actually steering the ship here? You might be wondering, why did these banks revise their targets in the first place? Well, they're really just reacting to the Federal Reserve and the broader economy. A perfect example is the recent jobs report. The market expected 110,000 jobs. We actually got 57,000. That's roughly half of what was expected. Because of this shockingly weak report, the odds of a September rate hike were slashed from 66% down to a literal coin flip at 50%. The rate hike case is just starting to completely fall apart. And the plot really thickens when you look at the Fed itself. That last June meeting, it was a 9-9 split on hiking. They are deeply, deeply divided. Meanwhile, core PCE, which you know is the Fed's preferred measure of inflation, sits at 3.29%, while the Fed funds rate is at 3.63%. Now, if they keep hiking into a weak economy, eventually something has to break. But if they don't, inflation stays sticky. Both of these paths heavily favor hard assets, and that is exactly why central banks are quietly but continuously stacking gold. Which brings us to Section 4, Summit Metals forecasts and holding the line. Because that core fundamental thesis of central bank accumulation remains totally intact, Summit Metals has confidently decided to hold the line. They aren't changing a thing. Their gold target for next April remains steadfastly at 5,500. That is significantly higher than that new bank average of 4,877, and it is miles above current spot prices. Their silver target? Also completely unchanged at 120. They're just ignoring the short-term margin call noise. We also have to look at the Summit Metals Pressure Index, which tracks the bias between investing in gold versus silver. It ticked up 2 points this week to 51. Interestingly, this maintains a very slight but historically dead-on accurate bias toward gold over silver right now. It just goes to show that even during the pullback, gold has been the much more resilient asset. And finally, Section 5. Your action plan. How to actually position your portfolio.
So how do we translate all this macroeconomic data into a strategy you can actually use? Well, Summit identifies 3 distinct investor profiles. First up, the leveraged investor. This is someone trading with borrowed capital. If this is you, the advice is crystal clear. Liquidate that position immediately. Precious metals are a financial insurance policy against a breaking economy, not a casino. I mean, you wouldn't take out a high-interest loan to buy home insurance, right? You absolutely shouldn't use leverage to buy metals.
Next up, we have the accumulator. If you're a long-term stacker, this is you. According to the data, we are at peak risk right now, so the smart play here is to stagger your buys to manage that risk. Don't go dumping all your capital in at once. Let the markets play out, stay disciplined, and maybe use an auto-invest plan to just average out your entry points. And finally, the seller. Look, if you're looking to offload metals right now, the golden rule here is don't overreact to those scary headlines we just debunked. However, if you actually need to sell for a real-world reason, like a down payment, a car, or a family medical emergency, do not let anyone make you feel guilty about it. That is exactly why you built this wealth in the first place. Use it when you need it. So, looking at the immediate timeline, today the market is just building a base after those brutal margin calls. But all eyes are on tomorrow at 2 p.m. Eastern when the FOMC minutes drop. That release is going to dictate everything because it will reveal just how committed this divided Fed actually is. If the faction pushing for rate hikes looks stronger than expected, we could absolutely see an immediate price retest of the lows next week. So, this leaves us with one really vital thought to ponder. We know the banks are reacting to the Fed, and spot prices are reacting to the banks. With the Federal Reserve fully in the driver's seat right now, how are you preparing to pivot your stacking strategy if they surprise us all with more hikes? Take a hard look at your investor